Welcome to another FAR walkthrough video. I'm Logan, and in today's video, we're going to be going over adjusting consolidated financial statements to correct errors. And we're going to be doing that the SuperfastCPA way, which is diving straight into questions to learn the material. If you don't know much about our strategies, make sure you go to SuperfastCPA.com and check out our free 1-hour webinar training. We will teach you the key ingredients to passing the CPA exam, and again, it is only 1 hour, it is free, and we will show you how to be effective and efficient with your studying. The link will be in the description, so make sure you go check that out. Also, just letting you know, we will only be going over 5 questions in this video, whereas Superfast CPA members will have access to the full 10-question video when we post it in the members forum. So if you like this, you can get more of it by becoming a Superfast CPA member. With all that said, let's dive straight into the questions. Alright, here we are at question 1. Beckett Holdings, Inc. acquired 80% of the voting stock of Landon Manufacturing Ltd. on January 1st. During the year, the two companies engaged in various intercompany transactions. At the end of the fiscal year, the following intercompany balances remained on their respective balance sheets after consolidation. Beckett Holdings, Inc. had accounts receivable from Landon Manufacturing totaling $150,000, and Landon Manufacturing had accounts payable to Beckett of $150,000. So it's the same thing. Which of the following journal entries should be made to correct the consolidation error? Now, this is a pretty straightforward question, and that's kind of how I wanted it to be. I want to jump straight into reminding you how this works for the intercompany and the consolidation transactions being eliminated and different things like that, just in case you didn't watch the previous video or if it's been a little bit since you watched the previous video. So let's go ahead and dive straight into the answer to remind ourselves of this. All right, the answer is C. The accounts payable of the subsidiary should be debited for $150,000, and the accounts receivable of the parent should be credited for $150,000. So let's walk through this. In consolidated financial statements, intercompany accounts such as accounts receivable and accounts payable and sales, we'll talk about that in a little bit too, between the parent and subsidiary should be eliminated to avoid double counting. The correct journal entry to eliminate these balances is: you debit the accounts payable of the subsidiary and you credit the accounts receivable of the parent in this situation. But basically, you're just completely reversing those accounts because in consolidation, they can't be there. This removes the intercompany receivable and payable from the consolidated balance sheet, ensuring that only transactions with external parties are reflected. And remember, that's the whole idea about consolidation and the eliminating entries and things like that, is you have to only reflect what happened between external parties and the consolidated company. It cannot be what happened between the parent and the subsidiary or the subsidiaries. So if it was missed and at the end of the year it's showing up, you have to make that entry to get rid of it. And that's what this question was about. With that, let's go to the next question. All right, here we are at question 2. Alder Corporation owns 75% of Birch Products, Inc. At the end of the fiscal year, the consolidated financial statements show a net income that includes the following accounts. They have sales revenue of $1,200,000. They have cost of goods sold, or COGS, of $800,000, selling and administrative expenses $150,000, and interest expense $50,000. During the year, Alder Corporation sold goods to Birch Products, Inc. for $200,000. By the end of the year, Birch Products, Inc. had sold 60% of these goods to external customers. The original cost of the goods sold to Birch Products, Inc. was $160,000. To accurately reflect the consolidated net income, how much of the cost of goods sold should be eliminated due to intercompany profit? So remember, this is the end of the year balances. They haven't made any adjustments as they should have, so we now have to go in and make this correction to eliminate what the intercompany profit should have been from cost of goods sold. So how much should be eliminated from cost of goods sold? We talked about something similar in the previous video, so if you remember how to do that, go ahead and pause the video and do the calculation. If not, that's okay. We're going to dive straight into the answer to learn how this works. Okay, here we are at the answer, and the answer is B, $24,000. That's how much should be eliminated from cost of goods sold. So let's walk through this. To eliminate intercompany profit from the cost of goods sold, we need to identify the profit on the portion of inventory that was sold to external customers. Alder Corporation sold goods to Birch Products, Inc. for $200,000 with an original cost of $160,000. The intercompany profit is $40,000, and that's pretty easy to see. If they sold it for $200,000, it was originally worth $160,000. That's a $40,000 profit between the companies. Since that's intercompany, though, we have to eliminate it. Since Birch Products, Inc. sold 60% of these goods to external customers, the profit associated with these sales needs to be eliminated. We already talked about that. The portion of this calculation related to COGS, cost of goods sold, is as follows. You take that total intercompany profit, $40,000, and you multiply it by the amount of the inventory that was sold, which in this case was 60%. So $24,000 of the intercompany profit has to be eliminated from cost of goods sold during the consolidation. Now, you'll notice that there is still $16,000 of intercompany profit that needs to be eliminated, and that would be eliminated from the consolidated inventory, but the idea behind this question, it was just asking about the cost of goods sold. So that's how much of the intercompany profit is going to be eliminated from cost of goods sold, is the percentage of the inventory that was sold multiplied by the intercompany profit that there was. All right, that was a good question. Let's go to the next one. Okay, here we are at question 3. Riverside Corporation acquired 100% of Hillside Enterprises on January 1st. The following are the individual asset balances for both companies as of December 31st of the same year. So this, by the way, the formatting for this is a little bit difficult. I had to kind of make it like this so I could fit it all on one screen. So bear with me. So here's the assets for the parent. They had cash of $300,000, accounts receivable of $400,000, inventory of $600,000, equipment of $700,000, and an investment in Hillside Enterprises of $300,000. And then Hillside Enterprises, who's the subsidiary, they had cash of $100,000, accounts receivable of $150,000, inventory of $200,000, and equipment of $250,000. So those are the end of the year asset balances after consolidation. So they've done the consolidation, and these are the balances that they have, and we're going to consolidate it here in a second. Here are the intercompany transactions that they had during the year. Riverside Corporation provided a loan, so this is the parent to the subsidiary, of $50,000. And Riverside also sold equipment to Hillside for $75,000, and it originally cost $60,000. So there was a gain between them. So those are the intercompany transactions. Again, nothing has happened. It's been consolidated, but none of these intercompany transactions have been taken care of. So what are the errors and what are the correct totals after we look at this consolidated amount and these intercompany transactions? So go ahead, pause the video, look through all the different numbers here, think about the intercompany transactions, and do the calculation to see where things went wrong so you can know what the correct total should have been for the consolidated assets. And when you're done with that, we'll look at the answer together. Okay, here we are at the answer A. The total assets should be $2,410,000. Now, if you'll remember, they're claiming it should be $3,075,000. So we have to walk through and figure out what the correct total should be with the corrections. So let's walk through this. So first we have to eliminate the investment in Hillside Enterprises, that's the subsidiary, from the consolidated assets, as the subsidiary's net assets are already included. So if you think about it, the investment is on the parent's assets, and then there's the net assets, but the investment represents the net assets of the subsidiary, and we're about to consolidate those into the consolidated financial statements with the parent, so we have to take out the investment so that it's not double counted. And the intercompany loan of $50,000, that's included in the accounts receivable and the accounts payable, but it should be eliminated to avoid that double counting. So the accounts receivable should be $500,000 in the end. And then there's the profit from the equipment sale. That was $15,000. We have to remove that from the books because they have to keep it as if it hadn't been sold intercompany. So you are eliminating that $15,000 gain so that it just shows as the original $60,000. So you add that all together, $400,000, $500,000, $800,000, $1,010,000, and then you subtract $300,000 of the investment, and that gives you $2,410,000. And if you think about it, that does make sense because originally they were including this investment, so instead of subtracting it, they would have added it. So it would have been at $3,010,000, even if they had done everything else correctly, but they didn't do the other two things correctly, which was the $65,000 other adjustments that we had to do. So overall, they forgot to remove the intercompany loan, they forgot to remove the intercompany profit, and then they also forgot to remove the intercompany investment, or like the parent's investment in the subsidiary. So once you remove all those things and correct them, then you get the correct total assets. And with that, let's go to the next question. Okay, here we are at question 4. North Shore Inc. owns 100% of Seaside Co. On January 1st, North Shore sold equipment to Seaside for $90,000, which had a book value of $70,000. Later in the year, Seaside sold this equipment to an external customer for $100,000. The following are the asset balances related to these transactions recorded in the financial statements as of December 31st in the same year. So you have all of this, the equipment, the accumulated depreciation, the gain on the sale of equipment for each of them. Now we have to determine the correct gain to be reported in the consolidated financial statements. So there's some gains happening here from them selling intercompany and also selling to an external customer. How much of this is going to be included in the consolidated financial statements? You could probably figure this out if you just think about it for a second. So go ahead, pause the video and do the calculation yourself. And when you're ready, come back, we'll look at it together. All right, the answer is D, $30,000. So let's walk through this. There's the intercompany gain. We have to eliminate that. North Shore's gain on the intercompany sale is $20,000. That was the $90,000 sales price to the subsidiary, less the original cost, $70,000. This gain should be eliminated because it does not reflect any arm's length transaction with an external party. So remember, all internal transactions have to be eliminated. All internal accounts or intercompany accounts have to be eliminated during consolidation. Now, there is still a gain that needs to be included. And let's talk about that. Seaside sold the equipment to an external customer for $100,000. The correct gain should be based on North Shore's original book value, not Seaside's recorded value. So that should be $70,000 is the original book value, and then there's the sales price of $100,000. So that gives you a $30,000 gain. And now, if you'll remember, they recorded a $10,000 gain. So they reported their gain based off the $90,000 sales price that they had when it was intercompany, but they should have used the original book value. So in the end, it's a $30,000 gain. The total gain reported in the consolidated financials should only include the external gain based on North Shore's original book value. The $20,000 intercompany gain is eliminated, leaving the true external gain as the difference between the final sale and the original book value. So again, remember in these situations, when there's any kind of equipment sale or things like that where there's an original cost, as far as the intercompany profit, that's eliminated. And then when you sell it to an external customer, you use the original cost, not the cost when it was sold intercompany. Let's go to the next question. Okay, here we are at question 5. Blue River Holdings owns 80% of Green Valley Ltd. The following are the balances for each company as of December 31st. So Blue River Holdings, the parent, had common stock of $500,000, retained earnings at the beginning of the year of $300,000, and the net income of $100,000. Green Valley had common stock of $200,000, retained earnings at the beginning of the year of $150,000, and net income of $50,000. And then when they consolidated, they're saying that the consolidated common stock is $700,000 and the consolidated retained earnings is $450,000. We have to determine the correct consolidated amounts for common stock and retained earnings. So they gave us the amounts that they had, but we have to do the correct calculation and figure out what the correct amounts should be. So if you watched the previous video, you'll probably have an idea of this. If not, that's okay. We're going to dive straight into the answer for this one. Okay, here is the answer. C, common stock should be $500,000 and retained earnings should be $440,000. So let's walk through this. When it comes to the consolidated common stock, the consolidated common stock should reflect only the parent company's common stock. Since Blue River Holdings owns 80% of Green Valley Ltd., Green Valley's common stock is eliminated in the consolidation. So because they are a subsidiary, all of their equity is eliminated. For the consolidated retained earnings, these should include only Blue River's beginning retained earnings plus its net income, plus its share of Green Valley's net income. And again, the important thing there is the share. So let's walk through this. They have the beginning retained earnings of $300,000. They have the net income of $100,000. And then Blue River's share of Green Valley's net income is $40,000. And so that is the consolidated retained earnings of $440,000. Now, just think about this. You don't include any of the equity from the subsidiary, except you would include some of the non-controlling interest. That wasn't part of this question, but that is the only thing that is going to flow over from the equity of the subsidiary is the non-controlling interest. There probably would be some non-controlling interest in this case because they only own them 80%, but that's not what we wanted to go over in this video. So as far as everything else, the common stock, the retained earnings of the subsidiary are not included in the equity of the consolidated financial statements. And then when it comes to retained earnings, only the parent's share of the subsidiary's net income is rolled into the consolidated retained earnings. The other portion is going to be non-controlling interest, right? So that's how it works. And if they don't do these adjustments and these corrections, then they're going to end up including everything like they did up here, where they just kept it all together, but you can't do that with the equity during consolidation. And with that, we've learned a lot in just 5 questions. Before we go any further, let's do one more part of the process called pillar topics. Now, the idea behind pillar topics is as you're going through the material, you will notice the things that keep popping up. You will notice, hey, I've seen 5 questions trying to teach me how to calculate the equity of consolidated financial statements. I've seen this, I've seen that multiple times. So you know these are the important things that you need to learn and know for the CPA exam. So you take a second during and after your session of studying, and you write them down as pillar topics so that you know them for later. Let's go ahead and look at the pillar topics for this video. All right, here we are at the pillar topics. First, intercompany transactions such as loans, sales, and balances between parent and subsidiary must be eliminated in consolidation to prevent double counting and reflect only external transactions. Next, the parent company's investment in the subsidiary is eliminated against the subsidiary's equity to ensure the consolidated statements reflect the net assets and liabilities of the combined entity. And then next, when the parent owns less than 100% of the subsidiary, only the parent's share of the subsidiary's net income is included in the consolidated retained earnings. Also, any unrealized profit from intercompany sales must be eliminated to ensure that profits reflect only external sales. That part's pretty straightforward. And then the consolidated equity should reflect only the parent's common stock and retained earnings adjusted for the parent's share of the subsidiary's net income. We kind of talked about that just barely, excluding any direct inclusion of the subsidiary's equity. So remember, all intercompany transactions have to be eliminated, and if there are any that weren't taken out, you're going to have to do the adjustments to fix that. And with that, now that we've gone over the pillar topics, that is the end of the video. And before you go, make sure you check out our free 1-hour webinar training on SuperfastCPA.com. Again, it is free, it's 1 hour, and we will show you how to pass the CPA exam. Also, just a reminder, we only went over 5 questions in this video, but if you liked it, remember that you can get more of it by becoming a Superfast CPA member because members have access to the full 10-question video when we post it in the members forum. If you liked the video, make sure to like it and leave a comment. I hope this was helpful, and I will see you in the next video.